We're live.
All right.
All right, I guess we're on. Hey, man, what's up, party people? It's Mackie. I've got a special guest today. It's exciting. It's a special guest, our Ben Brey. We're here to talk consumer discretionary, which is obviously bottom with the rest of the market. Ben's a partner at Convex Solutions. I don't let really anyone else run even a portion of my money because this is what I do for a living, and that'd be kind of embarrassing. But Ben is the proud sole runner of my money. He's my hedge fund guy, longtime buy-sider. He's the co-founder of Second Brain AI with a K. He's host of Benny and the Squirrel podcast. I was his first guest. He's my first guest. It's a pleasure to welcome him, even though he's a Wisconsin Badger. How you doing, buddy? How things going?
Good, man. Good. Yeah, it's an exciting time to talk about consumer stocks because I think I called you last weekend and I was like, this is just carnage everywhere you look. And to be fair, today old Gary at Restoration Hardware continued his carnage, right?
Yeah, we'll get to Gary and we'll talk some Nike. It's let's just put it into context. You specialize in vol, you specialize in kind of getting in and out of these things. As far as I'm concerned, it kind of just I like to dumb it down. The chart that plays is just the price of gas, 41% year to date versus consumer discretionary 9%. Correlation is not causality, except in this exact case where it precisely is. And I mean, this has just taken an absolute poleaxe to the stocks. It's been kind of unbelievable.
Yeah, I mean, I think that over time, the number one driver of variation in comps and short-term results is the year-over-year rate of change in gasoline because it's the most variable part of the basket for consumers, right? So this is a bit of a jump right here, right?
it's a bit steep, and it's the head of the spear. You can make it as complicated as you want. You and I talk a little more dorky when we're just talking to each other, but the truth is, I mean, it's from this flows everything. This is going to affect your demand side, but obviously everything that goes into the rising price of gas is going to affect margins on the shipping side, on everything else, and which is before you even get to international turmoil, sentiment, mood, anything else. The fact is, if you're paying 20% more for gas than you did a week ago, you're going to notice that and you're going to spend a little less, and that's going to hit consumers. Hasn't really yet, but let's just say that the earnings we heard over the last 24 hours weren't super encouraging in terms of a robust consumer bailing out the weaker companies.
Yeah, I think the gas is one thing, but I think that just accelerates a lot of weakness that was already present, right? It's been, me and you have been talking on Wall Street Beats for 2 years about how guys couldn't comp and everyone took so much price post COVID. And now it's just like a lot of consumers don't have much juice left. And so how do you grow, right? And now AI might be taking services jobs. The credit market's not good. And now this gas thing just seems to accelerate all the other trends that were kind of headwinds for the consumer, I guess.
Right. It's pretty much simplifying it. But I mean, we're at the point now where it's, I mean, let's just talk about Nike right away, just because it's kind of hard to ignore. 10-year lows, at least, with maybe the worst beat in the history of beats. They kind of gave it one of those we crushed. Your mic went out on me, Ben. What's that?
I was just laughing. I was just listening to you go.
Oh yeah, man. It's they're going with Jordan World Cup soccer kits because nothing says soccer to the global community like a 65-year-old former basketball star. China was not so great. Gross margins going down. The DTC business is terrible. Yeah, they might have been able to get away with something like this kind of 18 months ago, but 18 months in, the CEO, they seem to be kind of out of ideas. They used the word innovation something like 35 times in a call 18 months ago. I mocked them ruthlessly for that. But the idea of that was that something new would be showing up on shelves, and man, they didn't have it last night. It was ugly, and it's just they went from a stock that everyone wants to sell you. Everyone wants to say, in 6 months, this is going to be higher and you're going to feel like an idiot for not buying Nike down 50%. Today, you couldn't give this away with a bowl of soup.
Yeah, it's funny. Jillian, she told me maybe a year and a half ago, she said, you'd have to pay me to wear Nike. And that was a good insight because, or 2 years ago or something. And I was like, huh. And, she didn't know a shit about stocks, but she's in touch with brands. And look at Allbirds, same kind of thing. My buddy told me his girlfriend was making fun of him for wearing Allbirds. Well, that was a good insight too. So, sometimes with these brands, it is really just mind share and what's popular. And not that I'm the best at that, but I just think that when you start losing mind share of people, it takes more than a Nicolas Maduro jumpsuit fad to get you back in swing.
For sure. And you were a consumer guy at Fidelity, so you know where you speak. And truthfully, to give people a little peek behind the scenes of high finance hedge fund world, we kind of just gossip like an old sewing club half the time and just kind of, hey, what are you going to buy? I don't know. What do you want to buy? It's and sometimes, especially with these consumer names, you don't have to get more sophisticated than that. And they just seem lost. I mean, it's you and I both know a lot of people that wanted to buy these guys, and last night it was kind of a baby bathwater scene. You still end up with a company that's 35 times earnings, 35 times forward, and taking down estimates with too much inventory. With it seems like the CEO came in because he was really ticked off that he got kind of replaced by someone who wanted to do DTC in a big way. That was a disaster. He dedicated his whole term to fixing that, which they kind of did. They're doing less DTC now, but man, if you're Dick's, why are you taking a ton of Nike stuff that you're just going to have to mark down?
Yeah, it's funny you mentioned about Fidelity. I covered Dick's at Fidelity when it was a young growth story, and credit to Will Danoff, one of the great mutual fund managers of all time. He used to bug me about that, and he was running like $80 billion. Like, dude, this isn't going to do anything for your fund, but like you're going to get like a 2 bips of it. But he was on it, like, and they went from just the regional guy, and back then there was an oversupply of them, to now consolidating it. And in COVID, everyone was excited about the direct to consumer because no one was going to stores. So that's when you saw them peak in the top of the Mackie Christmas tree of death chart there. And clearly Dick's was too strong of a distributor for them that or they just, as you said, they didn't know what they were doing. And now they're kind of having to sit in their stew and try and, I don't know, reinvent themselves. It's harder to do with a stock that's down 70%.
And with absolutely no trends on your side. Their apparel, you can blame the death of athleisure, but man, they've got nothing going. Again, it's their devotion to the Jordan brand is just sad. He has all the relevance of actual Chuck Taylor himself, who was a basketball player in the 20s, as far as young people are concerned. There's just not a plan, and you can't promise innovation for 18 months and come up with nothing. So, people are chucking the stock. So much so that you'd love to be a contrarian. You'd love to say, you know what, at 15%, that's they're overdoing it. And they might be, but are you going to play this for a bounce to 50 when it just doesn't seem to really have anything going at all?
I mean, I think it's also the larger picture we've seen is these companies that I call them boomer companies, but like the guys who were kicking ass in the 80s, 90s, maybe the 2000s, like, and the world was a little different, kind of the pre-internet world, pre-Gen Z digital nomad world, and Walgreens was a great company, and it was the same thing, down and to the right, just kind of was losing its way. And you've seen this over and over. And UPS right now is another one that's kind of like that in a different industry. And so you got to be careful when a company's kind of post peak, then they lose some of their talent, harder to get the smartest people. And it's very hard to move a large ship, in a world now with AI, and you can replicate brands. Like, you go on Amazon, they're doing the H&M model, but without all the stores like that. They're getting stuff made, and they're looking with the innovators. And if you're a strapped consumer, people are going to be like, you know what, I'd rather have for $20 than $60, and makes it difficult.
Yeah. And to add insult to injury, Nike, who used to have Foot Locker as kind of a de facto discount house. I mean, that was really what they were, their off-price center was Foot Locker. They still had about 50% of Foot Locker sales. Now that's owned by Dick's. And I tell you what Dick's is not going to do is expand the Nike portion of the store and give yet more space to kind of the Nike apparel and everything else that's going on there. So it's hard to see how they get out of this box. Maybe we're marking the bottom with this talk, but I sort of doubt it, and I wouldn't put money on it.
Yeah. I think it's one of those, like, what do you think, what would it take, put it this way, what would it take for you to get excited to buy it? Is there a valuation level, or is there like I need to see some positive change that's more than one quarter type of thing.
It would honestly take at this point, it would take strategic kind of, it would take real innovation. It would take, they're getting some running shoe share back and they're scrapping away. But it would take something that Jillian, your girlfriend, and my wife, just some organic, I like Nike again type of stuff, because you're not going to sell enough Air Jordans to boomers to make up for the fact that no one wants to wear this guy's clothes, and just the trends are against you. It's a brand that's lost its way, and it's a big problem too, because man, it's really hard to turn around a $50 billion player in a space where the next biggest guys are like 15, 20. It's just a huge battleship that you're trying to turn in midstream, and it's not going well for Mr. Elliott.
Go ahead.
Speaking of boomer brands, we got to get to our favorite, and this is a little cultish, but indulge us, folks. Izzy, if you can run slide 5, we've got a little video. This is Gary Friedman of Restoration Hardware. This is how they released their earnings. This is their actual earnings release. There was no PDF. It just led you to this video. Izzy, roll 5 for me, would you?
Welcome to The World of Our Age. Albert Einstein's 3 rules of work. Out of clutter, find simplicity. From discord, find harmony. In the middle of difficulty lies opportunity. Seem especially relevant at this moment.
I mean, I'm wearing the Einstein hat for our boy Steve's company that I'm invested in, Einstein Energy, but like quoting Einstein at the beginning of a quarter is a bit much, isn't it, Jeff? Buddy?
Holy crap, is that the worst way to lead into a warning, a guy down, and a disaster? I mean, that was crazy.
Can you hear me?
I've lost audio on Ben. It was worth it. We can re-roll the Einstein clip for hours. Izzy, give me a Ben back if you can.
Stand by.
There we go.
Can you hear me now?
I can hear you now, baby. You're back, and we're there.
I mean, that was an incredible
crazy
way to open a quarter, wasn't it?
Holy crap. I've never seen anything like it. I've compared Gary's conference calls to dead shows because they just meander for like 3 hours, and he's the guy who famously he kind of staggered into the call a little late on Liberation Day and said, well, maybe our stock's going to take a momentary hit. Paused, saw the stock, and said, "Oh shit!" He's a free-flowing kind of crazy dude. But he tripled down. That company is no longer just selling furniture. They bought castles in England. He's opened a huge store on the Champs-Élysées with the idea that the Parisians are going to just adopt huge American furnishing styles because they have so much respect for our fashion sense. Way over his skis. They have an Aspen housing complex. They're got restaurants that are pretty high priced. You and I, Ben, have been known to enjoy a meal. I don't think we're going to be going to the RH restaurant. He's doing a lot of different stuff, and now he's got a huge amount of debt, and he's trying to sell $500 million worth of these enormous stores into a market that A, he's a desperate seller, B, not a huge amount of demand there. I think he's going to have a tough time getting liquidity. Are these guys just dead? This is making COVID era lows, which is pretty impressive for kind of any consumer name.
Yeah, I mean, they have $8 billion of debt. Let's call it, I don't know what you want to give them, like 3.5 to 4 billion of EBITDA. So you got 3 times leverage, and then maybe an extra half another turn with the rent, and he's just building an empire on other people's money. Now, to be fair, he has kept his stock in there. I'm sure he regrets, not selling at the top of the tree when he famously was like, I didn't sell a share at 700. Yeah, okay. Well, you know what? I think that this is a good brand, to be fair. I'm actually in the market trying to find a cloud couch. I hope that this guy gets to, put some sales on, get to boost up those things. It might just be as simple as that, Jeff. It might be the high-end housing market is done, and he's direct reflection of that, right? Because I'd say he's the leading brand. If you get a new house and you got some money and you buy a $5,000-$6,000 couch, and that market's slowing for all the macro reasons we talked about, and he has a good brand and he has good products, but again, there's price elasticity. It's a real thing, and maybe he's feeling that. And the problem with that is volumes matter, as you know more about retail than I do, is when you stop converting inventory to cash and you got to make debt payments and lease payments and employee payments, you can delever fast. So yeah, I'm not surprised he's selling some of his empire of nice units and stuff.
Yeah, that debt is a cruel mistress, especially in what even amounts to, I mean, it's hard to imagine a $10,000 couch would be low margin, but it becomes low margin pretty fast if you have to sell it for $6, and then it's not even moving at that. And you really need the cash or you're dead. That's a big problem.
That's probably the secondary thing they do, though, right? I guess I'm just putting myself, if I was Gary, I would do sale leasebacks first. Now, I get it that it's like, he's probably not getting the top dollar right now, but that's the thing about debt. It's not like at your choice anymore, the way it is when you're fully equity. Like this is, you're going to get forced into doing something. So yeah.
And that's kind of the thing with Gary. That's why he gets so much slack. He did take these guys out of the ashes. He's been there a long time. He absolutely delights. No one is more lethal when that stock spikes and kills the shorts than Gary. He is just an openly smug guy. I mean, it's you think he was quoting Einstein when he misses. Holy crap! He's Einstein's an idiot compared to Gary whenever there's a short squeeze going on. But those days seem to be over for now. You're right. Sales leasebacks it's not a great choice, but that's kind of step one of getting out of this 500 billion or whatever it is debt hole that he's got. It's just they're huge interest, 500 million, huge interest payments to be made, and you're selling low margin stuff out of castles in Europe. This is one of those stocks that they've been marking it down. It was really easy to talk yourself into taking a scalper on this one yesterday into the call. And man, those who didn't are blissful today. Down 22% today, 60% since February. If you think that the war is not having an impact on any of these companies, this is kind of item one. We saw with Williams-Sonoma, a much better company. Two CEOs who are kind of low-key rivals. They have really, really entirely different world views. Laura Halber at Williams-Sonoma is one of the best CEOs in the country, for my money. She seems to be winning the argument at the moment in terms of how to run a chain.
Yeah, they've done quite well. The stock hasn't really gotten rewarded, but that could just be reflective of, consumer stock's been the worst sector in the market year to date, and for obvious reasons. It's very easy to be negative on the middle, the consumer in general. And even like the Michigan survey said the high end starting to feel it a little bit. And so I don't know. I just guess that when I talk about the sales, like if you have a brand, it's hard to do sales because then you kind of cheapen the brand, right? And then you go down that slippery slope that many have. And he also sells those memberships, which get you the sale price, but it gives him some recurring revenue. Well, you're kind of screwing over your membership guys. So how do you move the inventory into a weak market is probably his greatest challenge. So it's not surprising the asset sales come first, then the hard decision of what do we do other than hope the market turns, basically, I think is the way to think about it.
Yeah, it's the paraphrase Munger, or maybe it was Einstein. I'm not sure. It takes decades to build a reputation and about 2 quarters to absolutely trash it. Yeah. Which is a liberal paraphrasing, but it's Gary tried to make a legendary luxury brand overnight, and that typically doesn't work well. Speaking of legendary brands and speaking of something that's working, unlike the Williams-Sonomas, unlike a lot of these consumer stocks that we've kind of been talking about here, the trade du jour actually, and this was the only way to make money on Williams-Sonoma, they reported a great quarter, but you can't report every day. That stock spiked up to 193, almost 200. It went straight back down. Last night, Dave & Buster's, a company that you and I have talked about since it was 30. It was cheap at 30, and boy, if it was cheap at 30, it certainly was cheap at $9.75, which is where it was hanging out last week. You and I talked about it over the weekend. take a scalper on Dave & Buster's. Why not? That stock's up 20-something% as we're talking. You can see in the long-term chart, that's an awesome move unless you bought it 3 weeks ago, in which case you're just getting your money back. You bought it 3 days ago, so it's been a fantastic trade. Is the move on these consumer names until we get some clarity on the war and peace in the Middle East seems like a big ask. But what are you doing with Dave & Buster's on the long side now? Because it seems that, are you just kind of taking the money and run and going out and playing video games, or is it worth it to call a bottom here?
I punted half of it. It's funny. One of my buddies is like, "Should we buy more here?" I was like, "This wasn't a great quarter." But like,
it was a terrible quarter.
They really knocked the ball off the cover here. But I called you last week or this weekend, or whenever it got below 10, I was like, F it, I'm gonna buy this thing into the quarter. I have no insight on the quarter. I'm sure it'll be bad, but this just seems so wiped out. You know what I mean? And like, you saw it with Lovesac. So just everyone knows, Jeff and I've talked about this. Two of the stocks that I've done well shorting in consumer over the last, call it 6 years, 7 years, were Dave & Buster's, which I actually participated in the IPO, and I was long it off the shoot when actually Minnesota-based Piper, well, it's Piper Sandler, but it used to be Piper Jaffray.
Piper Jaffray. Oh, geez, a bunch of smart fellows over there.
Yeah. Good Minnesota investment bank.
For sure.
But then, these guys basically lost their way when they went completely into the arcade business, disregarded their food and service business, and, just kept taking price. So, and then they were the most disingenuous guys because you'd like buy credits. You had no idea what a credit was, and the kid didn't. So credit just, Dad, can I have more money? Next thing you know, you blew $200 when you're like, well, I could have gone to Disney World for $200. Like, I'm at Dave & Buster's, right? So
yeah, I mean, these companies kind of come public and they start selling their soul immediately, and they start operating to it. If you're a private company, you don't fleece the kids by having them buy credits and make dad pay an extra $20 for video games while he's just trying to have a beer and watch the game. Like, you would never do that as a private company because no one wants to come back. You would also, if you were private, not open 11 new stores like Dave & Buster's is doing last year when your comps are negative. So you have negative comps. Your store model is clearly not working, but you can feign growth of some sort if you just keep opening stores. So we have a bunch of more new units coming in without really fixing the model. They last night on the call, they were talking about leaning into new video games, which if you're running an arcade, there's really no such thing. It's a new video game is called an app, and kids play it on their phone. I'm not sure how well that's going, but not the scum of the earth, not terrible management. They're leaning into the World Cup. That's a smart thing to do. Get people in there drinking beer, going to the World Cup. Just not a demo that you necessarily would see breaking out. And again, we saw this chart pattern, this spike up into not really breaking the trend line, but kind of flirting with it. We saw it on Chewy, we saw it on Williams-Sonoma, we saw it on Lovesac, which if you're looking for a sectional couch with a $5,000 speaker buried in the cushion, that's the best place to go. I'm not sure how large that market is, but they've been kind of giving up the ghost. It's when push comes to shove, no one really wants to stick around for too long in these names. You think it's take the money and run on Dave & Buster's?
Yeah, I think so. I mean, I'll look. It's 3 times free cash flow, so I'm not sure. Should trade at 4 or should trade at 5? So this could get back to $16, $17, and you without too much pain. I think my idea was like, look, I have a belief, that markets in the short term are driven pretty much by positioning and leverage. And there was guys who did want it out of here, and there was obviously some guys short, and the guys who were late shorts are now they're buyers today. And I mean, they still can generate cash. So it's like when we first started talking about this 2 years ago, Jeff, because I've been covering forever, is just cut your CapEx. Like, what are you doing? Just cut your CapEx and like get your stores in there. And it reminds me of the early days when I was at Fidelity and I owned 15% of Bed Bath & Beyond. I mean, not Bed Bath & Beyond, Build-A-Bear. Sorry, similar tickers.
Yeah.
And they had the same problem where they would open stores, open with a good, unit sales, and then slowly degrade. And the problem with that is if you keep opening stores, it's hard. You have to like do a lot of work of like, what's the average unit actually doing? And so if you're opening strong but continuing to put flat to negative comps, as both Dave and Buster's and Build-A-Bear did, you're just going to slowly erode, and then you're tricking the street in some sense. But you know what you're also doing? Adding OpEx, adding capital to a model that it's deteriorating year 3, 4, 5, and it doesn't really work. And so you look, Build-A-Bear eventually figured it out, and they're like, hey, let's do this a different way. And I know you made money on that monster run it had.
Yep.
I see it's gave some back though.
They're doing the same thing. They you know, it was time to sell, and you knew it was time to sell because they started opening again. They started saying, you know what's great is we're just going to open more of these Build-A-Bears. It's like, holy crap, you went from $3 to $100 just by getting your act together and staying alive and realizing you're just a great cash flow nostalgia business. You know, now they want to be a growth company because they feel like they have to justify and make up the street. And that was the end of that party, unfortunately. The little hearts and Build-A-Bears everywhere died.
I mean, yeah, I guess the whole point is that positioning, it's very easy to be very negative on consumer. And I spent the weekend, because I knew I was going to come on and talk with you, and there's just a lot of bad charts. Liberation lows, or some are at COVID lows. And, you know, so I would just say that it's easy to be negative, but like I remember in 2020 when I was buying energy with my ex hedge fund with my partner, and it was very easy to be a negative on energy at that time too. With you know, when oil got to negative $40, it was not necessarily a great environment. But you can say, okay, like, what am I getting here? What kind of cash flow? What kind of options do they have? Like, so it's a good time to actually do work and like look at things on an idiosyncratic basis, because when they're this beat up, like Dave and Buster's, that was not a good quarter, and you just had a 30% move in 3 days, right? So when it's this offsides relative to the market, it doesn't take a ton, and I think the whole consumer space has basically been funding shorts for owning SMH or owning memory stocks or whatever, even staples to some extent. But like, you got to remember, the pod shops are the incremental driver of stocks, and this has been an area that's been an easy funding area. And I don't know, you get to a point where it's just, you squeezed all the lemon out of the juice is the best way to say it. Like,
yeah. And it's a good time to get on the phone with managers. I mean, as a discretionary guy, or that's kind of where I party the most, but in the consumer space in general, do some footwork, go out to the stores. I'm looking for names, and I'm a total homer with this, and I'm a little embarrassed about it. But Target's been doing amazing. It's having a great year. And what's going on there is they've got smart new management, aggressive, like really kind of beating expectation type management, and a multiple of 14. I go to stores and the moms are back because they did the basics. They unlocked the product and they made the stores clean again. And it's amazing how fast you can overcome kind of a lousy reputation. That's a really nice stock for a time like this compared to like a Chipotle, which looks also cheap, but they're doing kind of their own version of what we just talked about at Dave & Buster's, which is they're cannibalizing their own stores by opening stores in a world where their comps are negative. So the store model is completely broken, but they're going to open nearby stores and fix the comps later. You're faking growth, and that just never ends well. That's a chart that looks terrible. The company looks cheap. I would, if gun to head, I would bet against them right now. If you maybe buy or short it, had a gun to my head, I would probably tell you to shoot, but if that was not my first choice, I'd go short rather than long, a name like that.
I think Target's a good example because, obviously you're Mr. Target, your dad is the CEO of Target, so you're just tied to the name for your life. But like, it was an easy sell calls against it. So I was doing that for a while, and I'm a long ball guy, but that was one where I was like, until I hear them doing something different, I'm just going to do that. And look, I'm doing it at a much smaller scale than some other guys are doing it. And that just is like an anchor on the stock. Then they come out, and like you said, they got a new CEO, they got a new plan, and we both bought it in November. Now I got out of there too early. So that's why I'm always hesitant, like with Dave & Buster's, like it could go to 20. But like, but look, that thing's been a great stock since November. Like,
and that chart's doing nothing wrong right now. That's been amazing. I mean, I am long my biggest positions at 97. I've got a nice Texas hedge in leaps because I think that there's just so much low hanging fruit. You know, they got sloppy. I would send you pictures and we'd complain about Target. You'd have to listen to me bitch about them because, again, I'm a homer. It's just because it's so silly just to keep your store sloppy when you're supposed to be the higher end discount chain. People like deals. Target is able to bring pricing down. They're able to unlock some product. I went there last night and it was honestly like my happy place. I was just kind of happy Gilmore, walking around, watching all the moms there with their kids. It was heartwarming, and that's not bad for a Tuesday night. And I tell you what, that's not priced into Target at 15 times earnings. It's just not that bad a company anymore. And there's way too many things that they can do. They're closing office space, they're firing people, they're making hard decisions that hadn't been made there in a decade. And that can go a pretty long way. Now, it can't necessarily go back to 240, but you can get up to 150 without doing a whole lot of really smart things.
And I think that's the point, right? Like, when you're in a beat up space like energy in 2020 or tech in 2022 or, consumer kind of right now, it's actually when you do put on your cap and you say, okay, let me get under the hood here, because there's things they can do, and you just assume that the consumer environment's going to still stink. But remember, Target's better than some other players, so the better guys will just kind of take share in these environments. And so you really want to be like finding the guys who can just wade or maybe even get better, especially if they were. I mean, Jeff, you used to complain to me all the time about you'd go in Targets and like just the lack of inventory and it was a mess, right?
There's tells at Target. There's just stuff that used to drive my dad crazy, drives me crazy still. You can't leave kid stuff on the floor. Like you better keep the kid stuff clean. It's relatively simple, seems kind of obvious, but a dirty Target is just an FU to their entire customer base. Because you've got these stores located in kind of nice neighborhoods, you're relying on people saying, oh, geez, that's a pretty good price for a baby dress, that she's going to outgrow in 3 weeks anyway. And as long as you kind of maintain that store model and respect your customers, that's pretty good. Now, are you going to take share back from TJX? No, but you don't have to do that again until the stock's about 150, 175. Then you raise the bar. But right now, Target just has to go across the border and kick the crap out of Kohl's, which Target can do that all day. It doesn't take much. They still have enough talent in the building to do that.
Yeah, and like I guess that's the thing also is when that calls like that, call overhang goes away and you start to get a few quarters, then you can get like the CTAs and quants and momentum guys back in there and they get a bid. And so sometimes it's self-fulfilling. And that's what I guess with like a Nike, you need to see them do something credible like Target kind of has done. And, it's easier said than done. So like, I'm not going to sit here and say I could go and do it. Okay. But I'm just saying that there are guys who are good out there. And if you have an iconic brand like a Nike or, a Chipotle or something like that, like you might just need to get the right guy or right girl.
I mean, whatever. And you can tell the plan when you hear it, and you can tell the guys that are full of crap when you hear it. If they start their video with quotes from Einstein and kind of soft focus Gary sitting there, they probably don't have any ideas. Nike last night, they spent maybe 10 minutes talking about Barcelona's stadium being rebuilt and how that was a metaphor for the great comeback of their chain. It was a weird diversion and a strange way to say, and next year we're not going to grow revenue again. It's you can recognize bullshit when you smell it. That's kind of where we are right now. No one's going to post a good quarter. As long as gas is going this parabolic, you're not going to see great quarters. And so it's still going to be carnage on sort of the margins and people that aren't executing. But a cheap stock on a plan is kind of good enough at where we are. It's just late in the game. Once you've had the worst quarter that you've seen in probably 3-5 years, easily in these consumer names, it doesn't take a lot. Again, no one's expecting great numbers at this point, but a strategy works and a little evidence in the store base that it's doing pretty well.
Yeah. I mean, I think in general, like the takeaway is that it's easy to be negative. You look at a Target as the anti-Nike kind of that, I mean, let's switch to Starbucks. How are you feeling about Starbucks? You were a big Nichols fan post Chipotle. How are you feeling about that?
I feel like they're in a little bit of trouble here. I see him and he looks like a guy who can't freaking believe that he's still dealing with unions 2 years into that job. And, it's again, one of those things, man, they rely on customers that are doing drive-through. They are selling a product that you can get cheaper just sitting in your house, or you can get 50 different energy drinks for about $2.50. And he's fixed the stores to a degree. He's made food better to a degree. Do I like it more than Chipotle? I think they make a good long short, but I would expect the short side to work more than I would the long side. I think it's just, there is no kind of magic CEO stuff. If in a better economy, perhaps he would have been able to do it better with a better employee base. He would have been able to turn it around. But right now, I was sort of looking at them as, it's you got to kind of go through the entire lineup and try to decide whether you're long, short, or just ignore it. But I don't think he's going to have kind of the nuts to take him through, at least right now. Again, it's you're talking about a mobile, that people that drive are going to stop less at Starbucks. That's precisely the kind of thing that, rich or not, you pay $130 to fill up your SUV. You're not that fired up to go spend $7 more at Starbucks.
Yeah, I mean, I think that's really the problem with it, is consumers kind of like whatever in last decade, and then you got this jump in money and forbearance of rent and childcare and all this stuff, and you put everyone in their houses like hamsters, and they let them run, and they spent some money, and their money was out there, and the stock market ripped, and then these guys were like, oh, we'll just keep taking price because it's a strong, economy in 2022, and then it kind of just wore out because all of a sudden everyone's like, wait, everything's 40 or 50% more expensive now, and now we're 3 on that, and I think a lot of people are tapped out. Maybe the high end, because stock market at 6,700, S&P we're fine, but I think the average guy, it's like feeling it. In Starbucks at $7, $8 lattes, Chipotle at $20 bowls with a beer and guacamole. It's just a lot, and then you kind of get in that angle, like, how am I going to grow, and so, and right. Gary, same thing, right. Gary was a beneficiary of that, and it's not a surprise that all those stocks, I mean, Nike's and RH's stocks, the same chart, right? Peaked at the end of 21 and down into the right since.
And just wildly different roads to get there, but ultimately just kind of fading brands that rely on a super strong consumer and just huge demand. Covered up a lot of sins for both those companies. But it's you can be crazy, or you can be just kind of strategically off base, and you end up in the same spot again. So we've got good plan, cheap stocks. That gets us a few things we can be long. We got nice trading scalps. Great job on Dave & Buster's. I would cash that in. You and I should go to Dave & Buster's and maybe play some video games and have some beers and bet on sports. Yeah. I think they should learn how to draft teams, as we were talking about. A little air hockey would be nice, man. What's more fun than air hockey and beers and betting on games? It's I can't believe they're not doing
thing real quick. When you think about we're lapping the tariffs, right? So is there going to be some kind of benefit to these guys? Because Trump got overruled by the Supreme Court. It was a year ago. Liberation Day is tomorrow, a year ago, right? So could that be an incremental positive on a very negative sentiment right now? I don't know. What do you think about that?
What I think about that is I think that, kind of like the tariffs, which stayed sloppy all of last year, I think the retailers can adjust to flat gas. I think as long as that pressure is going incrementally higher, it's going to be a problem. In other words, with the tariffs kind of proved, we started that comeback. He didn't back off the tariffs. He just sort of started moving the goalpost around. We can deal with that uncertainty as long as it's not just going directly more expensive the way it was that first day in the Rose Garden. In the peak, ironically, it's so you had the Liberation Day just ass kicking, and they went down for 6 straight days before Trump backed off. The very top of the XRT, the main consumer ETF, was when the Supreme Court overruled his tariffs. That if you go back and look at the chart, it was 91 something the XRT hit. It's been kind of a straight mess all the way down ever since. So, for fans of market irony, they don't ring a bell at the top. They just get ironic and say, hey, look, the tariffs are gone and we're going to start a war. So, it's I think that the first thing you need is that first chart I showed. We need this purple line on the average price of gas to stop going higher every single week. And then we can figure out what the damage is going to be. Because right now, companies can't report every day. Williams-Sonoma, if they could talk every day and say, you know what, yeah, yesterday was a pretty good day of sales, maybe you can support that stock. But once they get off the call, once they stop reporting, it's like, yep, nice quarter, but boy, are they screwed, because their consumers just going to be taking it in the 5-hole for the rest of the quarter, and they're never going to go buy a coffee machine again. And that's really what's facing these consumer companies right now. As long as the pressure is getting higher, that question is going to override kind of the sensibility of wanting to buy the dip. I got to ask you, because I ask every macro guy who comes on, you're the sharpest one I know. Again, I give you my money for it. What can go right? I mean, what would you look at that you would say, you know what, volatility's topped here. It's time to bail. It's time to just pull back the horns.
Do you want me to say what can go right about the consumer, what can go right with the markets, or both, or what?
You just give me a reason to believe, man. You know what I mean? And I'm only half kidding.
Yeah.
You know, I mean, it's because I think the stocks will reverse. I think that like you said with the tariffs, we didn't need much. It's not like he repealed all of them, and then that was only when the stocks started taking off. The stocks front ran a little bit, but that was a huge trade. We talked in November where, just the idea that Santa Claus was coming, that there was going to be a Christmas. That was a huge, obvious trade. And the sentiment was pretty ridiculously bearish about the third week in November, until finally you saw kind of the Black Friday sales came in, as they have every single year forever. But what's our catalyst this time around? Peace in the Middle East seems like a high bar, because we haven't had that in 2,000 years. So failing that, is there something Trump can say? Is there anything that you would look at as a catalyst that would get you long? I mean, across the board, not just for a scalp.
So just so you guys know, like in the fund, the Jeff's an investor of mine, like we long ball, we've done really well this quarter. We had a lot of it out on Friday, because it was like the S&P was at the 300-day moving average. It just felt so big, and so we got in a pretty good 3-day rally. I guess on Monday was just flat, but here's where you could go right? Like, this situation in the Middle East abates. Iran's kind of tired of having their country getting smashed. There's some kind of deals. The U.S. now kind of runs Strait of Hormuz, which is, just so everyone knows, that's a very strategic thing for the U.S. now, because it's a true countermeasure to China invading Taiwan. So maybe a little bit of a global peace. Prices come down some. I don't think we're going back to 60, but maybe just not going to 120 or 150, even staying at 100 is good. And then you just kind of a situation where I think the tariffs come off, that helps a little bit. And I think rates are going to go lower. So, old Gary wants the rates lower. The housing market's, stuck in the mud, if not going down. You get rates
Laura
lower.
Wants to get rates to go lower. Gary needs rates to go lower. There's a little bit of a distinction there.
And then you get a situation where, okay, vol's elevated, credit spread's elevated. That comes in, you get a little vol crush, that gives you a little bit. But then you have a situation where, I'm involved with an AI company called Second Brain, and I think that people, and agentic AI, and how much this is going to help a lot of small, medium businesses that didn't have access to proper software before. And yeah, there's going to be some frictions, as there always is. The bank teller and the ATM, the coal worker, whatever. I think it's a little hyperbolic right now. I just think people will adjust. But even if it's kind of bad, I think that it can be really good for the companies that are public. So weirdly, stocks could even if, and we've seen that, to be fair, this whole K-economy bananas thing is the stocks market's in there, but the average consumer is kind of on its ass. And you could see that sell. And even though maybe a median person's utility in life isn't improving necessarily, the stocks could do okay, because there's a lot of cost savings that can be realized. And so it's not exactly like everyone win-win society like that, but it could be good for the stocks. And since we're going to talk about stocks, that would be the way I would say it. Rates going down can alleviate some of the left tail risk with credit and stuff. And if people make their businesses more efficient, better, the capital owners should benefit from it. But long-term societal things beyond the scope, I think, of this conversation.
Way beyond the scope. It's bigger picture, though. This would be the first kind of industrial-related revolution that didn't ultimately involve in people being more prosperous. I mean, it's the internet was bad for newspapers. It's hard to argue that it didn't help kind of the broader economy as a whole. which,
Yeah,
it remains to be seen. I guess if
right?
I guess if the robots kill all of us, that'll be a bad thing. But in the meantime, it's been worked out okay so far.
Yeah. So I mean, look, it's good. Who makes money in their markets? I'm still an optimist. I still love humans, and humans figure it out. Like I think that if it gets to the point where they're going to be replace so many people, there'll be like a political movement or something, and they'll tax it, and that's what you probably want to like watch for, is if AOC becomes president and doesn't care if the market goes down 50%. Like that would be your real risk, basically. In that, but like for the moment, not for the time being, I think you got to just start using this stuff, trying to make your own business. Like there's just opportunities there that weren't there in the past. They're only there to big companies. And so I don't know. I just think that like actually digging into companies is basically going to be interesting right now for the first time in a while, because you had a re-rating down, negative sentiment, new tool that can be used to make your business run better. Tariffs is off your neck a little bit. So there's reasons you could be constructive. It's easy to be negative, I guess.
Okay.
But like,
you will leave it at that. There's reasons to be constructive. Hey, he's Ben Brey. Thanks so much, Ben, for coming on, man. Really appreciate it. Nice talking to you on video. We don't Zoom that much because we're men and men don't Zoom. So it's nice to see you. It's nice to talk with you. And it's nice to let people enjoy our conversation. Yeah. All right, man. We'll talk to you soon. Hey, folks, thanks for tuning in. We will see you next week. Stay safe out there and find a reason to be optimistic. It's not all bad.
Yeah.